Smart Fination here. Now, listen, many of you have been asking for Market Warrior Part 4. Great news, it's out now. That exact thing just occurred in India. Gold surcharges spiked this week to $112 per ounce above official local prices. That's the peak level since May 2014, over 10 years back. And here's what makes that figure hit hard and meaningful. Only 1 week prior, sellers were giving discounts of up to $12 per ounce. And what we're seeing is a $124 shift in surcharge within 7 days, fueled by worry before India's February 1st budget 2026. India ranks as the world's second biggest user of gold and the top user of silver. When the tangible market in a nation of 1.4 billion enters frantic purchasing phase, shelling out $112 above spot to grab supply before a possible tariff increase, that's far beyond a domestic tale. And it serves as an indicator of worldwide physical need patterns that might alter silver's trading path through the remainder of 2026. The direct trigger is simple. India's Finance Minister, Nirmala Sitharaman, will deliver the union budget for 2026 and 27 on February 1st. Market observers are guessing the authorities might lift tariffs on gold and silver to limit imports and bolster the rupee, which reached an all-time low of 91.74 versus the US dollar on Wednesday. Present tariff sits at 6%, reduced from 15% prior to July 2024, when officials cut rates to curb smuggling and encourage formal bullion inflows. That reduction succeeded, formal inflows soared, and the underground surcharge dropped sharply. But now, with the rupee fragile and the trade gap expanding, there's broad anticipation that tariffs could revert higher. Chandra Vanchesh, managing director of Hyderabad-based bullion trader Caps Gold, informed Reuters that folks are guessing the government might boost tariffs and preparing for the rise. Sellers are applying surcharges over peak prices. Need was truly robust this week and outpaced availability. Let me illustrate that in figures. Bullion sellers applied a surcharge of up to $112 per ounce above official local gold prices, which includes 6% tariff and 3% sales taxes. Last week, those same sellers were providing a discount of up to $12. That's a $1 to $24 turnaround in 1 week. Gold surcharges in India typically fluctuate within a band. Discounts happen when supply outstrips need, frequently during times when buyers postpone acquisitions due to elevated costs or economic doubt. Surcharges arise when need races ahead of supply, spurred by celebrations, marriages, or, in this instance, policy concern. A surcharge of $112 marks the highest since May 2014. The prior occasion, India faced comparable alarm before significant policy shifts. Local gold prices hit a new peak of 159, under 26 rupees per 10 gram on Friday, January 24th. That's powered by both the worldwide surge in gold nearing $5,000 per ounce and the rupee's decline versus the dollar. Now here's where silver comes into play. Silver surcharges in India climbed to $8 per ounce this week, exceeding the former high of $5 reached in October 2025. That may not appear as striking as $112 for gold, yet for silver it's enormous. India stands as the world's biggest silver user, representing a major share of global ornament, industrial and investment need. When silver surcharges in India soar to levels unseen in months, it indicates physical purchasers are ready to pay well above worldwide spot levels to obtain supply. And unlike gold, where investment need prevails, silver in India fulfills twin roles: investment and industrial. Solar module makers, electronics creators, ornament producers, and individual investors all vie for the same tangible supply. Let me outline the drivers. First, the identical policy worry hitting gold is affecting silver. If authorities increase tariffs on gold, silver will probably face a parallel rise. Present tariffs on silver match gold at 6%. If that shifts back toward 15%, importing silver becomes instantly costlier. Industrial consumers needing silver for production can't delay. They are securing supply now at 8 surcharges instead of facing 50s or more after the budget. Second, the rupee's drop to an all-time low raises costs for all dollar-based imports. Silver trades in dollars worldwide. When the rupee falls, Indian purchasers spend more in local terms for the same quantity of metal, prompting advance buying before additional currency weakness. Third, Worldwide silver prices sit at historic peaks. As of this morning, silver trades at 10,396 per ounce after reaching an all-time nominal peak of 10,345 on January 23rd. That's over 200% above January 2025. Indian purchasers pursue an ascending global price while also facing rising surcharges. Now, here's the element that reshapes my view of all we've covered. India used over 8,000 tons of silver in 2024 and 2025, equating to about 25% of worldwide fabrication need. The Silver Institute notes that India's silver need stems from three main areas: ornaments and silverware, industrial uses including solar modules and electronics, and investment need via coins, bars, and ETFs. When surcharges jump to $8 per ounce, it reveals all three areas are vigorously competing for scarce supply. Ornament need in India stays robust during marriage seasons and festivals. January through March marks a high period for weddings, boosting jewelry buys. Industrial need has sped up thanks to India's huge solar growth, electronics production under the Make in India plan, and vehicle manufacturing. Investment need rises amid currency volatility, which matches the current rupee lows. The calculation here is clear yet important. If Indian purchasers pay $8 surcharges over a $103 spot level, they're really paying $111 for tangible silver in India. That's a 7.7% markup over global spot. For gold at $112 surcharge over roughly $4,700 spot, purchasers pay around $4,112, a 2.4% markup. Silver surcharges are relatively bigger, indicating the tangible pressure in silver exceeds that in gold. Why? Silver's market is smaller and less fluid. Global silver mine output is about 820 million ounces yearly versus gold's 3,000 tons or roughly 96 million ounces. Yet silver's industrial use alone exceeds 600 million ounces, offering little space for investment and ornament need without deficits. When a market like India's, taking 25% of global supply, begins paying record surcharges, it pulls metal from elsewhere and restricts worldwide access. Let me describe the situation on site. A Mumbai-based bullion seller with a private bank told Reuters that ornament need is quite soft, but investment purchasing has also eased with prices at peaks. Still, anticipation of a tariff rise has boosted gold appeal. That remark is key. Even with soft ornament need and slower investment buying from high prices, surcharges keep climbing. That shows the surcharge stems not from natural need, but from policy advance buying. Sellers and institutional purchasers are hoarding metal before the February 1st budget reveal, wagering tariffs will climb. If tariffs do rise from 6% to 10% or 15%, those who bought at $112 surcharge today will gain since the after-tariff price will climb further. This is speculative hoarding atop underlying need, swiftly pulling metal from circulation. Now let's explore implications for worldwide silver supply networks. India lacks major domestic silver output. Almost all use comes via imports, as refined bullion or through doré refined locally. When Indian importers pay $8 surcharges, they outbid other regions. Silver that might reach Europe, North America, or other Asian areas redirects to India for the top offer. This triggers a chain reaction. COMEX listed stock, meaning silver ready for prompt delivery, has fallen for months. London storage has experienced large outflows. Shanghai surcharges, though less intense than India's, remain above usual levels. When several key use hubs pay surcharges at once to lock physical metal, it indicates the paper price on COMEX or LBMA fails to capture the actual cost of obtaining physical supply. Here's the intriguing part. For the wider silver outlook, the Silver Institute forecasted a market shortfall of roughly 95 million ounces for 2025, the fifth straight year of fundamental shortfall. BMI from Fitch Solutions expects the shortfall to persist into 2026, mainly from stronger investment need. When India, holding 25% of global use, shifts to frantic buying and pushes surcharges to multi-year peaks, it worsens that shortfall. If Indian purchasers advance 3 to 6 months of use into January and February before the budget, that's possibly 2,000 to 4,000 tons of silver or 64 to 128 million ounces taken in weeks. That amount matches or surpasses the full yearly shortfall. It's a need jolt atop existing tightness. Now, I'll cover the negative view since real dangers exist. First, if India's February 1st budget avoids tariff increases or the rise falls short of forecasts, the frantic buying might fade. Surcharges would drop and some January hoarded metal could return to circulation, weighing on prices. Second, elevated surcharges kill need. A Mumbai seller noted ornament need is quite weak at present levels. If silver holds above $100 and surcharges stay high, Indian ornament makers might cut output and buyers delay acquisitions. That need reduction would relieve tangible pressure. Third, if the rupee stabilizes or gains versus the dollar, the currency-fueled part of the buying rush would fade. Fourth, worldwide slowdown dangers linger. If production activity drops sharply in 2026, industrial silver need might fall, balancing investment need. Fifth, at high prices, recycling and scrap supply grows. India holds large above-ground silver reserves in ornaments that could be sold if prices remain elevated. But after listing those negative points, see what occurred this morning. Silver reached $103.96 per ounce, a fresh record peak. India's surcharge jump hasn't hindered the global surge, it's speeding it up. Why? Because when tangible buyers in the world's top silver-using country accept $8 over spot, it confirms the idea that paper prices disconnect from tangible truth. COMEX futures may close at 103, but securing tangible silver in Mumbai or Chennai costs $111. Add the current $8 surcharge and post-budget silver in India could hit 120. Here's the takeaway for tangible owners and traders worldwide. If you hold tangible silver, you're set in a market where one of the biggest users signaled readiness to pay record surcharges for supply before policy shifts. That's a need indicator backing higher prices despite other bearish turns. If you trade COMEX futures, note paper and tangible prices are splitting. A $103 futures close doesn't guarantee tangible silver at $103. You're paying $111 in India with high surcharges elsewhere too. That split opens arbitrage chances but adds risk if short tangible without sourcing options. If tracking silver miners, no rising prices don't guarantee rising output. Miners sell at spot but face costs in local currencies. If the rupee keeps falling, Indian industrial users facing higher import expenses might cut silver-heavy production, potentially slowing sector need growth. The main factor to monitor is India's February 1st budget reveal. If tariffs on gold and silver climb from 6% toward 10% or 15%, this week's frantic buying gains credibility. Surcharges will hold high or rise further as late buyers rush in. If tariffs remain 6% or increase slightly, surcharges will drop and some advance need will reverse. But here's the vital truth. Even if surcharges drop, the fundamental shortfall persists. India keeps using 25% of global silver. Industrial need from solar and electronics grows, not shrinks. Investment need surges worldwide, not only in India. The shortfall stood at 95 million ounces in 2025 before this frantic event. Adding 60 to 128 million ounces of pulled forward need doesn't solve the core issue. It merely changes when pressure peaks. So when India pays $112 over spot for gold and $8 over spot for silver, don't brush it off as local oddity. India is the world's second biggest gold user and top silver user. When such a huge market enters surcharge-paying frantic phase, it signals global tangible scarcity. And when that frenzy comes from policy advance buying, not natural need, it shows even savvy buyers think true metal cost exceeds current spot levels. That's not negative. It's confirmation the tangible market is tighter than paper reflects. And in a market facing the fifth straight year of fundamental shortfall amid record investment need and policy-driven hoarding, surcharges aren't irrelevant. They're real-time price discovery. Connect those dots,